Okay, let's dive right into this explainer and look at exactly how childcare operators can completely master their end-of-financial year planning. Because as anyone in this industry knows, running a center takes incredible passion, but surviving and truly thriving, that takes absolute precision. You're dealing with heavily regulated revenue, complex childcare subsidies, rising costs that are totally dominated by award wages, and a compliance load that, well, never seems to let up. So today, we're going to break down a really comprehensive 2026 EOFY checklist that is specifically designed to give you back total control of your center's finances.
Right off the bat, I want you to ask yourself honestly, when do you actually start thinking about the end of the financial year? For so many operators, it's just an afterthought, right? A stressful, last-minute scramble in July. But the end of the financial year on June 30th is the one fixed point where really smart operators stop, take stock, and set their center up for the entire year ahead.
We've got a fantastic blueprint for this explainer, covering 5 core pillars: the EOFY mindset shift, maximizing your deductions, navigating super and payroll, compliance and center economics, and finally, state taxes and succession.
Let's kick things off with Section 1, the EOFY mindset shift, moving from reactive to strategic.
Think about the stark contrast between these two approaches. There's the reactive operator who finally meets their accountant in August. By then, the financial year has completely closed, and the levers you could have pulled to minimize tax, they're entirely gone. You're simply reacting to a result you can no longer change. Then, you have the strategic operator who acts right now, in May or June. They're projecting their income, actively shaping the outcome, and making crucial decisions long before that midnight clock strikes on June 30.
Moving right along to Section 2, maximizing your deductions, seizing the opportunities before June 30.
So, the absolutely crucial point here is this exact number, $20,000. If your aggregated annual turnover is under $10 million, the instant asset write-off allows eligible centers to immediately deduct the business use portion of assets under $20,000. But here is the major catch. The window for this specific benefit closes on June 30, 2026.
What does that actually look like in practice for your center? Well, this $20,000 threshold applies per asset, meaning you can apply it to multiple items. We're talking about new playground equipment, commercial kitchen appliances, IT and software systems, new furniture, or even replacing all your sleep mats. But, and this is a massive but, these items must be installed and ready to use before the financial year ends. You can't just order a bunch of stuff on June 29th, leave it in boxes, and expect the deduction.
Beyond physical assets, you can also pull future deductions into this year's tax return. Small businesses can generally bring forward a deduction by prepaying expenses for the next 12 months. This means you can prepay your rent, your insurance premiums, software subscriptions, or even your NQF professional development. Basically, anything you know you have to pay for anyway, pay it now before that June 30 clock runs out.
Okay, let's transition to Section 3, navigating super and payroll, managing the largest cost line.
The upcoming timeline maps out critical dates you absolutely cannot ignore. First, your rosters must account for the 12% super guarantee that kicked in back in July 2025. Next, looking at right now, you really need to pay your June quarter super early to claim the deduction this financial year because employer super is only deductible in the year it is actually received by the fund. And finally, looking ahead to July 2026, you must start preparing for the massive cash flow compression of payday super. Super is going to need to be paid at the exact same time as wages, which is a huge shift for wage-heavy childcare rosters. You need to model that cash impact right now.
And hey, while you're crunching the numbers for your staff, remember to review your own remuneration. For the 2025-26 year, the concessional before-tax contribution cap is $30,000. Also, if you operate through a company or a trust, you absolutely must ensure all owner drawings, director's fees, and trust distributions are properly documented before year-end.
That brings us to Section 4, Compliance and Center Economics, minimizing audit risk and mastering KPIs.
The ATO compliance load? Yeah, it literally never lets up. But following a simple, methodical process reduces that anxiety immensely. Step 1. Ensure your relief educators or cleaners aren't misclassified as contractors. Misclassification is a super common and incredibly expensive audit finding. Step 2. The ATO loves digging into Division 7A loans. Simply put, if your company loans money to you personally, it has got to be on commercial terms with minimum repayments. Otherwise, the ATO will tax it as an unfranked dividend, and trust me, nobody wants that surprise. Step 3.
Just reconcile and finalize your single-touch payroll before that strict July 14 deadline.
Now, let's talk pure economics, 75 to 85%. Most long day care centers need roughly this occupancy rate just to break even at current award wages. If you cannot confidently state your specific break-even occupancy percentage off the top of your head right now, that is the very first thing you need to go and fix with your accountant.
Instead of drowning in dozens of confusing metrics, you've got to translate your abstract accounting into a really tangible KPI scorecard. Take data from your enrollment software and your accounting software and turn it into a single source of truth. Monitor occupancy by room to maximize your revenue. Track wage cost as a percentage of revenue so you are rostering strictly to ratios rather than just out of habit. Monitor staff retention and keep a super close eye on debtor days, meaning parent fee arrears, to protect your cash flow. These are the measures that actually explain your past and predict your future success.
Let's wrap up our main pillars with Section 5, State Taxes and Succession, the big picture. Childcare naturally has several obligations set by individual states. Multi-site operators really need to watch out for state payroll tax grouping rules, which can inadvertently combine related entities and just push you right over the tax threshold. You also need to ensure you're claiming GST input tax credits correctly. And critically, if you are even just considering selling, retiring, or succession planning down the road, you absolutely must structuring for small business capital gains tax concessions years in advance. Do not leave this until you're literally sitting at the settlement table, or you're going to miss out on some substantial tax reductions. I want to leave you with a really brilliant insight from our source material. The operators who get the absolute most out of year-end aren't necessarily the ones with the biggest centers or the highest fees. They are the ones who treat 30 June as a planning deadline rather than a reporting date. They're the ones who consistently carry the strongest cash position because they proactively plan rather than react.
So, what's it going to be? Before that window closes in June, what specific action from this blueprint will you implement today? Are you going to book that planning meeting? Will you model the payday super impact? Take charge right now to ensure your center doesn't just survive these regulatory and economic pressures, but genuinely thrives in the year ahead.